Okay. Um, Thank you for joining us, Ben. Today we have Ben Lyon. Ben Lyon is CEO at Hoover. Ben, maybe you could introduce yourself briefly.
Thanks for having me, Raymond. I'm Ben Lyon. I'm the CEO at Hoover Developer Services. We just go by Hoover. I've been working in African fintech for about a decade now. First company I co-founded was Kopo Kopo in Kenya, which was a merchant acquiring company, kind of like Square in the US, but for mobile money. Then went on to work at a fintech accelerator called DFS Lab, where we invested in, while I was there, about 7 companies. Mostly fintech across Africa and South Asia. And now I'm working on Hoover, which is a developer tools company. We're trying to help developers build on top of mobile money, specifically in Africa, to build out the next layer of financial services.
Wow. Thanks, Ben. So this afternoon, we thought that we would turn to, fintech integration across Africa and how, mobile money is developing that. So one of the things that has come out in recent times is everyone keeps talking about this Paystack example. I mean, Paystack just did whether it was an acquisition of something or 200 million, it was acquired. That's a very big stamp of approval for the African ecosystem. It's something that is not usual, but it happened. So I think it's timely for us to turn to building a successful, fintech company. And, Ben, you just mentioned your, exceptional career of, working for all these years in fintech. What was your experience like building, your first fintech venture in Africa?
Where to begin? In 2010, so I graduated in the recession in the United States with a liberal arts degree, so not very marketable as a person at that time. And by chance, it wasn't my intention. I actually wanted to work for the U.S. government when I graduated, but by chance, I somehow ended up on a plane flying to Nairobi to start a business with 2 guys that I met on Twitter. I really don't recommend this path for anyone. We just kind of got lucky, but it's not an advisable path. It shouldn't work. So it was kind of by accident that I slipped into entrepreneurship. It wasn't my plan. And even further by accident that it was so far away from where I grew up, which was Arkansas. So, whatever got us there, we started in 2010. We had this sense that this mobile money revolution was happening, and it was just in the beginning phases. And that by the time it was over, incumbents that we all recognized would be gone or look completely different. We just recognized that there was a kind of a massive state change happening in the world, and we wanted to be a part of it. We just didn't see where that white space was. And so from 2010 to 2012, we were really in the customer discovery kind of product development mode. And that's when we stumbled on the first kind of product market fit with Kopo Kopo, which was this merchant payment opportunity. So we built the first merchant aggregator for the mobile money industry, where if you were in Nairobi paying for, say, coffee at Java House, that was actually a payment being received and processed by Kopo Kopo, who was then going out and acquiring those merchants, doing all those value-added services, reconciliation, et cetera. So that process, how we got there is circuitous, but in that process, we had to learn how to work with banks. We established multiple bank partnerships across Kenya, Uganda, Zimbabwe, Ghana. We had to work with 10 plus telcos, integrating with at least 10 mobile money systems. We really got to see how kind of hairy and fragmented the space is. So maybe if you can remind me, I guess, which part of where you want to dive down in this. I can just say that it was kind of an accident how my career started. But seeing the fragmentation and seeing the opportunity in fintech in Africa, starting in East Africa, where I have the most experience, once I had seen that, I couldn't look away. It's just the opportunity just keeps getting bigger and bigger in my mind. And so I've dedicated my life to it.
Okay, sounds good. So let's touch a bit about your experience with, engaging partners. I think it's an old adage that you can't build a fintech product without the right partners, including the banks. So what was that experience like? Let's layer it into two types of partners: the more regulatory partners, and then those that help you build out the solution, like the banks. How was that experience like? What were the banks looking for? What were the regulators curious about, and how did you go about that?
Yeah, I don't mean to be provocative, but I have had no relationship with regulators to date in my decade experience. And so in the Copo experience, we were a pioneer in the sense that we were ahead of regulation.
Yeah.
We weren't anticipated or defined really in any law. And we were operating just unregulated, much like a clothing store, but holding millions and millions of dollars of merchant funds. And so this terrified us and continues to terrify the company because, it's a large, it's processing many hundreds of millions of dollars now. And we always wanted to be regulated. So that maybe this is the instructive bit. In my career, I have sought regulation. I have sought relationships with regulators. We've proactively briefed central banks. And yet to this day, I've never had a productive relationship with the regulator. So generally, my view is that that's not the path to success, especially in the beginning, incipient phases of a company. I would look at kind of that regulatory kind of partnership much later down the line, as when perhaps you're mature, you're looking to do an IPO, just much later stage. Maybe you need to help define what new legislation is. But for early stage, I've never started there. I've never seen success starting there. I know we're going to talk about Sandboxes a little bit. And so I look much more on kind of the bank telco incumbent side when I think about partnerships than the regulatory side. And that's its own complex kind of area. So banks and telcos are very different. Of course, they're all different within and between countries. It depends on, is it a competitive market? Is there a dominant player? So all of these kind of factor in. My main takeaway with partnerships, especially with telcos across the continent, is that it is a dynamic and ever evolving partnership. And so it's not kind of a set it and forget it type relationship. It's a relationship that needs to be actively fostered and really maintained. And if you don't do that work, I think the way that the telcos generally work is that their inertia is just against startups. And so if you want to survive a partnership with them, you really have to maintain that very actively. And that means like knowing who the decision makers are, having relationships with them, being supportive to them, helping them hit their KPIs. And so it's not, partnerships are difficult and require active investment, I think would be my point.
Yeah, that makes so much sense. And one of the other things before we leave, the issue of partnerships is at some point, there's always that temptation to build your infrastructure up. You build infrastructure by yourself. Maybe, for example, you decide to build your own digital wallet, but most of the telcos have thought through a lot of that stuff for you. They'll probably have a collection account or something like that. When do you make the decision to cross over and build your own infrastructure or integrate and use what they have? What do you think could be the factors that you consider to do that?
Yeah, I think it's fundamentally a question of what are you trying to do? And what are you trying to do that is unique? What is your competitive advantage? What is your enduring strength? And so I think if you are not an infrastructure company, if that's not your core service, you shouldn't be building this infrastructure, in the same way that if startups are very modular these days. And so if I'm in Seattle, Washington. So say I wanted to start a company here serving Americans, we'd think, okay, for SMS, I'm going to take this Twilio bit. For hosting, I'm going to do AWS. For linking bank accounts, I'm going to use Plaid. And so in my mind, I just have all of these blocks that I can assemble together to make new companies. And so if your company is to be one of those blocks, then you should be investing in that infrastructure, absolutely, because that's your competitive advantage. And so that like a Paystack or a Flutterwave, that's what they're doing. And that requires really massive investment. And Stripe acquired Paystack because Paystack has done an exceptional job. And that really requires precision focus. They chose, this is the bit that I'm going to own. And then they nailed it. So if you're going to be the infrastructure company, yeah, for sure, build that. If you're not the infrastructure company trying to do that, build all of that infrastructure yourself in the beginning of your company, is kind of the path of fools. Now, that doesn't mean that you shouldn't build it yourself over time, or maybe you shouldn't. You know, there's no clear answer there. But it's likely that as you're growing, you'll consider like, okay, now I need to switch out some of my infrastructure providers for in-house tech because it'll lower costs, give me greater agility, something like that. Yeah, but you don't want to put that up front because you really need to be focused on what is it that you're trying to build your company around. And it's probably not around optimizing your margins.
Yeah, yeah, makes sense. Well, the touchy topic for fintech, and I'm glad it worked for you at the time that you were building Kopo Kopo, that there was a bit of regulatory unclarity, that the regulation was not, you know, that clear yet, and it was playing that. But you know, in a world now where regulation is beginning to pick up on fintech and how, you know, things should work, um, and I'm guessing even in your later years in the company, that is something that eventually came up. What key piece of advice or what key thing do you wish you knew before you went down that path of trying to get regulation?
Yeah. I yeah, so what do I wish I could have told my younger self starting a company uh, related to regulators? I guess it would be avoid, honestly, like avoid regulated activity as long as possible because it's a bog. Um, you know, I appreciate and support the sandbox efforts. I know several regulators. You know, I don't question the spirit whatsoever. It's just in terms, we move in different wavelengths. We move at different speeds, startups and regulators. And if you are a startup founder, do not wait for the regulator. Do not depend on the regulator. They're literally not there to support you. So just getting in the right frame of mind that you know, what is the function of a regulator, and what is your job as a startup founder? They're very often not the same, and the overlap is minimal. So yeah, it's just difficult. There are money laundering concerns, there's terrorist financing concerns. Like, we need an active regulator. We need an active regulator. And yet the speed with which regulators move, the speed at which legislation changes, the takeaway I would just try to share with any startup founder is you will die long before the regulator is ready to have a conversation with you. Whatever the public kind of presentation is. So just prepare accordingly, and focus on building a service that your customers love and building a large company, and do right by your customers and do no harm, and anticipate regulation, anticipate what best practice will become if it doesn't already exist, and move there. So don't wait for the regulator. They will always be behind you, chasing you. You have to define what the future looks like and where we should go. So that's the headspace for the founder, I think.
Wow, it's a powerful message. Um, Speaking of the sandbox, very touchy topic for, you know, a lot of fintech innovators. I call it the sandbox loop. On the one hand, the regulator says, you know, let me give you a chance to try this out with me, and then we see where it goes. But when you look at the statistics, for instance, in Kenya alone, the CMA by August of 2019 had only given 3 startups a sandbox license. In Rwanda, for instance, the sandbox license existed on the laws, but no startup had been approved to get the sandbox license in quite a while. Well, do you think sandboxes have been effective? What do you think? What reforms should be put for these kinds of, you know, initiatives from day one to make them effective? If you think otherwise.
Yeah. I have never engaged personally with any of the sandboxes, and I don't really have an informed opinion on kind of what they should do and how they're operating. I have more of a an opinion from distance, and it's just kind of an observation. it is bizarre to me to have a regulator gating the innovation space. Uh, and so if they're at the entrance, if they're the very gate to enter, like, first, I don't want to play in the sandbox. I want to play on the beach. And then for the regulator to be determining who can get access, of course, that is their prerogative. You know, that's why they exist. And also, just fundamentally, this is the very issue, isn't it? There's an assumption, and there's a book called The Master Switch by Tim Wu that I'd recommend everyone read, just talking about the rise and fall of information empires. There's just this assumption in the sandbox type approach, I think, it's kind of a centralization assumption, which is I have to gate everything because I have a monopoly on good ideas, and I can use my judiciousness to say yes and no. And it's just not the way. I don't think that's the way the internet works. I don't think that's the way information works. And I just don't think that's how. I don't think they'll be successful in that role. I can tell you, as an entrepreneur, I don't look at a sandbox as an asset or a springboard. I don't consider it. I just think about, like, I'm going to the beach. I'm not interested in that sandbox. I want the whole beach. And so whatever is between me and the beach, I'm going to find a way around it within the law. And that's just what any entrepreneur is going to do. So unless they make that equivalent to me with the sandbox, like, what's the incentive to participate in the sandbox? What is my incentive to raise my signature so that the regulator can see what I'm doing in detail? Why would I do that as an entrepreneur? So I don't have the answers to those questions. And as a CEO, as a founder, before I would even contemplate like a sandbox, I'd be wondering that, like, who's funding it? What's their mandate? Who's gone before me? I don't want to be a guinea pig, so that's all very, it's very uncertain to me. And as a founder, I don't think it's my job to add unnecessary uncertainty to my path.
Makes sense. Well, the other bit that we get asked quite a bit by fintech companies, at which point should you be brave enough, with all the regulatory uncertainty, with all the the lack of regulation thereof in some markets? At which point do you approach a VC firm or investors to actually get a piece of your company?
Yeah, I think it depends. And so if you're just beginning your company, say you've got an idea and a pitch deck, and it's you and two friends, that's probably the right stage to raise angel investment. So find some high net worth individuals, either if you can in your network, so you can get those warm intros. Of course, it's difficult to get those networks and to get plugged into those networks. But I would start in that incipient phase, just thinking about angels. So how can I get some quick money using a simple template like the Safe or the convertible note, or I think this other template you're working on. So just keep it easy. Focus on non-institutional, high net worth individuals who can write a $25,000 check and get that money coming in quick, so that you have oxygen in the body to function and to focus on the business. Do that, and maybe add some micro VC or kind of like super angel fund in that stage. I would call that your pre-seed. So angels, seed funds. Once you've gotten a little traction, you've gotten your idea to maybe an app in the market, some early users, maybe you're now ready to go raise your seed. If it's really taking off, you could go raise your A. At that point, I would be looking at, again, seed funds, moving into venture capital firms. I would avoid private equity until you're very late stage in your company. But generally, you're looking at that earlier stage now. You've moved from angels to seed and Series A. You're really in venture capitalist territory. Yeah, and then I just encourage everyone to really do mutual due diligence and pick your partners. There's a ton of money out there. Really, it's hard to get it. And so it's difficult to hear this, that there is a ton of money out there for venture. You really do want to pick the right partners. Not every dollar is worth $1. Some dollars are worth 80 cents. And I'm looking for the dollar that's worth $1.20. And so what that means is you want to find that person that's going to be a real thought partner for you. Ideally, someone that has some operating experience. They're going to be able to have empathy with the founding team because startups are really hard. And so that's over and above the money. That's where you want to be focused on. What's my relationship with this person like? I'm going to spend maybe more time with them. It's like a marriage. So, don't just jump in. You're going to spend a decade with these people if you're right, and you're going to go through a lot of intense stuff together. So do your diligence. Yeah.
Sorry, maybe before we leave that, portion of the conversation, which aspect, is a barrier to raising these finances for a fintech company, and maybe which aspect promotes, or which factors promote you raising, this kind of money from investors if you're a fintech? Are there things that founders should look out for? If I'm a fintech, is it maybe I'll leave it to you because this is your space.
Yeah, I think just generally it's a very networked industry, and so finding ways to get warm introductions to investors, I highly recommend. I'll offer myself here. Please, if you have a way to share my contact details, or even my email is Ben, BEN at usehoover, USEHOVER.com. I'm happy to help share my network with entrepreneurs. I know the DFS Lab, that's dfslab.net, is investing in pre-seed fintech companies across Africa and Asia. So I'd encourage you, I will open my network. That network exists to help. And so step one is get plugged into the network. That's typically the hardest thing. If you are an African entrepreneur, or you're building a company serving an African market, and you are finding yourself in fundraising conversations, spending more than a couple seconds locating your market for your investor, or you're spending more than a couple seconds maybe talking through a nuance about your market that is apparent to you but isn't to the investor. If you have to explain things, like in my case, we've had to explain before, like, what is M-Pesa, what is USSD, pay attention to those things. You're probably talking to the wrong investor. And so it's not a matter of, what do I need to do to convince this person? That person's probably the wrong person for your company. Because again, not every dollar is worth a dollar. Some dollars are worth 80 cents. And so if this person just happens to have a dollar, but they don't know anything about my market, my company, my stage, entrepreneurship, they are negative value add. That dollar is worth less than a dollar. And there'll be a drag on my time as CEO. And so I avoid those investors. And I think what you want to do is just have and they should avoid you, because this is a two-way street, right? So if they're not a fit for you, you're not a fit for one another. So I think the entrepreneur needs to do a lot of pre-screening, and it's not just a matter, don't spray and pray. Don't just plug into a network and send your pitch deck to 1,000 investors. You have to pick and you have to qualify them. So who has invested in my region? Who has invested in my market? Who's invested at this stage in this sector? Have they invested in a competitor? What's their average ticket size? What's their ownership target? So these are the questions you want to have answers to, ideally, before you have that first conversation, so that when you go into that conversation with that investor, you're speaking to them. You're not speaking to their asset class. You're speaking to that person, and you're plugging in, like, you're helping them understand why your company is relevant to their fund. And so you really have to do that research. If you're not prepared, and if you come up, people will tell you who they are if you do the research. So you want to find out, look, follow them on Twitter. What are they talking about? What are they not talking about? And just be prepared when you go in. So you shouldn't be surprised in a pitch. If you're talking to an investor and they pause you and they go like, wait, what is MTN? Like, you shouldn't have gotten into that meeting in the first place. There was something happened, something broke.
Yeah. Wow. Quite interesting. Well, it's been exciting having you, Ben. I think the last thing I would like to ask, and maybe that could be your parting shot, is the last bit of the road for the company. Exits, very sticky, very interesting. In a lot of African companies or African founded companies, or those that are planning to scale out of Africa. What do you think works, and what do you think might never work?
Yeah. So let's talk about good exits, maybe. Yeah. So it may be difficult to differentiate in 2020 because we're all basically sailing through this hurricane together. And so I think you'll see some opportunistic kind of mergers and acquisitions where you and acqui-hires where you have companies going bankrupt or just on a failure path and they're opting for a soft landing. So I think we'll see a lot of that. And I'm not talking about that. That's an okay outcome relative to a horrible outcome. But we want like great outcomes, like what Paystack got, or what DPO Group got. Like that's what the ecosystem needs. So how do we get there? What did Paystack do? Paystack focused on their customer. They focused on one little bit, this niche or niche. I never knew how to say that. And they owned it, and they did it exceptionally well. And they're the best. And so I can tell you, we as Hoover, we have developer docs. We're a developer-facing company. We're launching a consumer-facing app right now, separate point. But we had a goal of making the best developer docs on the continent. That was last year. And we benchmarked to everyone else's API docs. And Paystack just every time was always the category leader. And so this is, I'm kind of belaboring the point here, but be the best. Like that's the simple advice. Be the best. Really focus on your craft. Own your craft. Own a specific vertical and just go deep. And that's what they did. Beyond that, I think you'd see that from legal perspective, your governance has to be right. You have to have good accounting. You have to have done your legal. So you have to be able to sail through a diligence process. You can't have a messy cap table. You can't have books that don't reconcile. So governance is essential. You won't have a good exit without good governance. That's for sure. Team, culture, vision. Have you identified a market that is growing and is going to continue to be growing? Is this a large growth area over the next decade? So a Stripe-like player looking at a Paystack is thinking about, look how enormous Africa is going to be by 2050 and how central to the world Africa is going to be. Don't you imagine that some large percentage of that GDP will be going over the internet? So Stripe just called a 10-year shot, and that was great. So be thinking on those timelines also. Do you have relevance in 10 years? Are you building toward a market that is large and growing in that timeline, or is it diminishing? And then also there's relationships. And so that the Paystack Stripe relationship didn't just happen. Stripe led their Series A, I think. So that's been a relationship over many years. These things don't just crystallize. It takes lots of active effort. And there are many, I'm sure the Paystack team had many relationships like they have with Stripe kind of working concurrently. That's just the one that got through. So I have, I'm sure they got competing bids as well. All of those are relationships over years. And that's kind of the soft side of those transactions you don't see that I'd pay a lot of attention to. Ultimately, we want to do business with people we like and trust. And that's just true in business everywhere. And so you're now doing that in a global community where you're bridging these communities, you're bridging identities and cultures and trying to generate those bonds of trust now in a more dynamic environment.
Yeah. Thanks, Ben. Wow, it's been a very exciting conversation today.